Okay, hi everyone, Daryl here. So this is lesson 53 in my YouTube playlist Investing 101, and today we're going to talk about bid and ask. Okay, actually this is quite a simple topic, and most of you guys who are already in the stock market, right, know what is bid and ask. But I need to highlight this because a lot of people, right, what they do when they buy stocks is that they just take the market price. Okay, they don't, and then when they sell, right, they also just sell using the market price. So must always remember that you have the ability to bid and offer. Okay, so it's also commonly known as bid and offer. So the bid, right, represents the bid price or the maximum that a buyer is willing to pay for a stock. So if you see like maybe a certain stock, right, is hovering at maybe $9.10, right, then the buyer may bid maybe $9. So that's the maximum that the buyer is willing to pay for a stock. So when the stock price drops to $9, right, then the order will be made. Then the buyer will be issued with the stocks that he bid for. Then the ask, right, represents the ask price or the minimum price that a seller is willing to sell the stock for. So if let's say the seller in this same scenario, right, maybe the price is now $8.50 or maybe $8.70, then after that maybe the seller say, oh, I am willing to sell it at maybe $9. So the seller will put in ask price of $9 to try to make an order in the market. Okay, so the bid offer spread, right, is the difference between the bid and ask price. So if let's say you see like the bid offer spread is maybe like 1 or 2 cents, then the smaller the spread, right, the better the liquidity of a certain stock. So this may be a bit more foreign to everyone, but bid offer spread, right, is actually advantageous to what we call market makers. So there are people out there, right, or institutions or firms out there, right, that whereby like brokers, they try to make a market. That means that if let's say a certain counter, a certain stock, right, has an order for a certain price, right, then if they think that they can make money, right, then they go and they purchase the price, the equity, in the hope that in the near future, right, they'll be able to sell it off for a higher price. So they are considered market makers. That means that they try to make a market when the market is not there. So what they do, right, is that they earn the spread. So if let's say the bid offer spread, right, if the difference of the bid offer spread is very small, right, then the market maker is willing to accept a smaller bid offer spread. The main reason is because the market is constantly moving, so they just make small, but they make a lot and fast. Okay, this one is maybe a topic for another day, but just remember what is bid and ask. So here, right, I took out an image from Yahoo Finance, and then this one is actually Singapore Airlines Limited. So as of closing at 22nd May, right, the this is the stock price. But what we're interested, right, this is not a live market, so I just let you see what is on the on Yahoo Finance. So you can see here bid, right, is 3.630. Then after that ask is 3.64. So that, like I mentioned, right, the bid represents the bid price or maximum that a buyer is willing to pay for a stock. So you know that in the stock market, right, there are many buyers out there in the stock market. So what they do, right, is that they just bid. They bid on their, maybe they are using Saxo Traders or TD Ameritrade or maybe Lim and Tan or UOB Kay Hian, okay, or whatever platform, or DBS Vickers. Okay, so then after that, right, what they'll do, right, is that they will go to their back end, and then they'll place the order. So they'll say, I'm willing to buy maybe 1,000 shares of $3.60 SIA at $3.63. So an order will be put in. Then this price, right, is the closest to the market price. That means that if this is the maximum that a buyer is willing to pay for a stock, right, so if somebody is $3.62, right, down here will not put $3.62 because there is somebody who is willing to pay a higher price for the stock, so which is $3.63. They'll always put the highest bid. Then this ask, right, they'll always put the lowest bid. So you can see, right, if let's say the bid and ask spread is very low, right, this is quite liquid, so most probably you will be able to trade, find a buyer or seller for the stock. But these are actually on the main board. So if you can go to the Singapore is a catalyst board, right, which is a lot less volume. So what they do, right, is that you can see the bid and ask, right, actually don't match one. So the whole day, right, you can put in a bid, but then there's no trade being made at all. So this is just some basics about trading equities, and this bid and ask, right? Try to use it. Don't always just take the market price. Think very carefully what is a fair price. Use some metrics to calculate, then make your appropriate bid. Then if you get it, then you get it at the price that your you deem feasible for your investment portfolio. Okay, so that's all from me, and I'll see you in the next video. And if you find anything useful, right, please like, and then do subscribe to my YouTube channel, and I'll post this investing 101 videos, right, every week on Monday. Okay, so see you guys.